Expecting clear signals about where the Indian economy is headed, the latest GDP figures are a mixed bag. The third wave of COVID really caused a break for the economy in the Jan to March quarter, slowing the GDP growth rate for a fourth straight month to 4.1%. The economy had grown by 1.6% in the same period last year. Meanwhile, the annual GDP growth in 21-22 rose to 8.7% versus a contraction of 6.6% in the COVID-hit 2020-21 period. Powering this charge was a 3% growth in the agri sector and a 9.9% growth in the manufacturing sector. The construction sector grew by 11.5%, financial services by 4.2%, and trade and other services by 11.1%. There was meanwhile some good news, with the 8 infrastructure sectors rebounding in April to 8.4% growth versus 4.9% in March. Joining us on the show, Madhavi Arora, lead economist at MK Global Financial Services, and Prasenjit Basu, chief economist at ICICI Securities, to discuss these headline numbers. Madhavi, let me start off with you. Did they meet the estimates you had in mind? Were you disappointed with either of the headline figures?
No, I think the numbers was largely in line with our expectations. We were looking at close to around 3.9% on the fourth quarter, as against 4.1%, which was expected by the implied numbers of CSO. So I think to a large extent it was in line. On the production side, of course, we were seeing impact of Omicron-related curbs, which likely seems to have slowed the fourth quarter recovery, especially in the contact-sensitive, intensive services. Moreover, we also were seeing rising input costs, which would have probably added, further pressure on manufacturing growth, and that's why we saw a much lower manufacturing growth on a sequential basis. At the same time, the high base of last year also had weighed on the YOY growth numbers in fourth quarters, and we also see some revision in the early part of this year in terms of first quarter numbers. So I think on net basis, not much of a surprise in the fourth quarter. For the full year, we were expecting a revised number of 8.7%. So I think pretty much in line with our estimates as far as the FY22 numbers are concerned.
Okay. Prasenjit, what do these numbers really portray in terms of growth going forward, and the kind of prospects we're looking at for the current year?
Well, I think the most heartening feature of the numbers is the pickup in fixed investment spending. Fixed investment spending grew in real terms at 5.1% in the latest quarter. Nominal growth was about 15%, over 15%. And that suggests that we are seeing an acceleration, a steady pickup in fixed investment spending. To our minds, that is really the likely story of what will drive India's growth in the period ahead in the current fiscal year. I think also that India has been underestimating real GDP by quite a bit over the last 2 or 3 years, because there's a very wide gap between the balance of payments, current account balance, which is measurable and observable. That is generally running at about just over 1% of GDP for the full fiscal year. But if you look at net exports, the nominal net exports of goods and services for the fiscal year, they're running closer to 3% of GDP. That is a very wide gap. And if you look at the real number, it's over 5.5% of GDP. Real is based on deflators of exports and imports, and it basically is saying that our export prices are rising much faster than our import prices, and so there's a very wide gap in real terms or in inflation-adjusted terms between exports and imports. That is completely, it defies logic. So in fact, not just this year, but for the last 2 years, I am estimating that that the official GDP numbers that are being put out by CSO are actually about 2.5 to 3 percentage points lower than they should be, because of errors in the net export count.